Okay, so you should have just joined me now for Mercury, and let me start. It's pretty wild, isn't it? It's pretty wild. Let's start this one as well. If you've just tuned in to the extra channel, we've got Mercury coming up in 15 minutes time, and here on the main channel, we're about to do Achieve Life Sciences, so we're going to go live here as well. So let's do that now. We'll go live on both at the same time. Here we go. And let's go live now. Here we go. So if you're over there on the extra channel, you are now watching Mercury. Here on the main channel, you are watching Achieve Life Sciences. It should be up in a couple of seconds' time. Here we go. There we go. Good morning, good evening, good afternoon, and welcome to Martyn Lucas Investor. On the main channel, we are covering Achieve Life Sciences in 15 minutes time. On the extra channel, we are covering Mercury. So there are two earnings going on at the same time. It's a very, very busy evening as we prepare for PPI in the morning. You can see we are still in extreme fear despite the fact that the markets are rallying. Got to remember that we could have a big scare in the morning and people are going to take profit. That's how these things work. But anyway, welcome to everybody on the extra channel for Mercury, and welcome everybody here on the main channel for Achieve Life Sciences. So let me go through now and make some updates to the system so we can get everybody all signed in and in the right place. Because I can imagine it's a little bit crazy at the moment. Everyone's running around going from one place to the other. It's absolutely fine. Someone just said, I'm in the wrong channel. This is what happens when there's two shows at the same time, right? It gets pretty wild. So here on the extra channel, we are now watching Mercury. Mercury will be coming up in a few moments' time. Tap the like button. And here on the main channel, we are watching Achieve Life Sciences. That's what's going on over here. Let's see which audience, which show is the biggest. We shall see. All right. Bloody hell, we've just gained 40 subscribers in a matter of 2 minutes. I think that's the biggest ever. 40 in 2 minutes. I've just checked that. That's, whoa, bloody hell. 1,200 views in the last... Wow, that's great. Hell, never seen anything like it. Right, fantastic. 15 minutes to go before the earnings begins. Both events start at the same time, so it's going to be quite exciting. So, if you are on the extra channel now, you are watching Mercury. If you're on the main channel, you are watching Achieve Life Sciences. And welcome to everybody. Let me just make sure everybody is in the right place. I'll give you all the links if you want to swap between two. Frederick, welcome as a member. You can now chat now in the extra channel if you like. Achieve Life Sciences here on the main channel and Mercury on the extra channel. Let me just double check now everything is as it should be. Switch account to investor. We want to make sure we're all good. There's a lot of moving parts, all moving at once. But once we get closer to the earnings, I shall have gone through all the tests and checks, and we shall be good. Okay, so here we go. Let's make sure that's good. Please go over PBM. PBM, we can cover the earnings for you. If you are a member, Kyle Brogan. If you become a member of the family, we can cover earnings for you. I've just given you the links there if you wish to become a member. All right, it's a member's perk with a $5 super chat. That's all, and you get many, many perks, including earnings. Closed captions. Oh, we can't put that on now. That's a shame. I was hoping to do that. Never mind. All right. We're just adding all the bits and pieces in. We've got about 15 minutes to go before the earnings start. I will be going to an audio check in a moment to make sure all earnings are updated and ready to rock and roll. So please bear with me if you hear any noises in a minute. Okay. So we're all good here on the main channel now. Now, we are going to run some polls in a few moments as well, which I'm going to cover. I haven't quite got that far yet, but I will be in a moment. And let's have a look. Switch account, extra. Let's do that. Let's check the feed is good on the extra channel. You're watching Mercury. Let's have a look at that. That all looks good. Yep. Let me make sure we're spot on there. Yes. Okay, that's all good. All right, we shall leave that there. So then, now we're nearly up and running. We've got 12 minutes to go. Let me start. We've got our polls to put on X. So, first of all, if you are on the main channel, here is Mercury live now. Whoops, live on extra now. Mercury. Okay, I shall pin that to the top if you are interested in that. And Achieve Life Sciences is going into the extra channel. Live on main. Achieve Sciences. And I'm going to give you the link for that there. Okay, there you go. Now you've got both shows. Please tap the like button if you wouldn't mind. That would be fantastic. We've got a bigger audience tonight on Mercury stock. More people are interested in Mercury stock than they are in Achieve. So let's make sure that we've got all of the information up. Here is the chart for Achieve on the main show. There's the price. Let's see if they've beaten. We shall find out in a couple of seconds' time. They've actually missed on earnings. Achieve Sciences were expecting to lose 23 cents. They're losing 25. So we've got that. Achieve as well. Let me just submit this once again. You've got to refresh the screen always. Oh, there we go. There's the audio coming through for Achieve. So we're rocking and rolling over there now. That's looking good. Fantastic. Let me now just go and check the systems over on Extra, because that's about to start as well. Okay, here we go. Over here on Extra. There it is. And we've still got a bit of time for this one. Yeah. I think Mercury Systems has a while to go. We've got, let me just check what time that is. Mercury Systems, I think it's on the hour. I think it's on the hour. Mercury 3:15. I think it's on the hour. Yes, it is. So we've got a little while to go before Mercury starts. But I will be listening in and checking in every few minutes to make sure we are good. Let me check as well. The 13th. There we go. Mercury. Expected. Yes, it's August the 13th. 3 p.m. it says here. That can't be right. You haven't started yet. Hasn't started yet. August 13th, Eastern time. No, that can't be right. It's not yet. It's another. Oh, there we go. That's what I'm looking for. Yeah, Yes, it's 4 p.m. So we've got half an hour before Mercury. So I'm keeping my eye on that to make sure that the times don't change. We do get issues like that sometimes. So we're all good. So we're all in place. Let me just check around the studio. So Mercury on extra. And on the main channel. Achieve Sciences. Here we go. I'll be right back. Back at the studio now. There we go. Okay, we're all in place. So we've got a bit of time. Mercury is 8 minutes to go. So what we're going to do now is we're going to do a couple of polls for you. So we've got 8 minutes to go. So what we're going to do now is a couple of polls. So first of all, we're going to go to Achieve Life Sciences. And we're going to run a poll. Is it a beat or a miss? Well, we know that already. Is it a buy, hold, or sell for you? So let's do this on X. I will give you the link in just one moment. ACHV. Live now on YouTube. I'll give you the link in a moment. Join the I'll share with you what I'm doing so you can see what I'm doing. I'm on my X account. If you wanna vote in these polls, I'll give you the X account. There is my X account. Join now on YouTube. Join the investors. Why watch? Whoops, a daisy. Why watch alone? There you go. So here is ACHV main channel. This is the link. This is what I'm doing now. And let me do this here. ACHV. Achieve. I'm not going to put Achieve Life Sciences because that's too long. I doubt if they use that as a hashtag. Martyn Lucas Investor. Right, now then, add the image. ACHV. I've just done this somewhere. ACHV. There it is. There is it. There it is. Okay, so I'll add that. Now then, if you want to vote, the question I'm asking you is this. I'll make it a bit bigger so you can see what I'm doing. We've got 5 minutes to go, so you won't miss anything. We are early. We're always going to be early. Is this a buy, hold, or sell for you? Please vote in X poll. So here we go. Is it a buy, hold, sell, or undecided? There you go. And I'll run a poll for 7 days. There it is. So there is the poll if you want to vote on it. I've given you the link in the chat so you can go and vote on that right now. There's my X account. And I'll come back to that poll shortly. Let's come back to how much time we got left. We got 5 minutes. So let me put this quickly on my Facebook page and group. We're against the clock. We always are. No matter how we prepare ourselves, we're always against the clock. ACHV. Here we go. Instagram. I do this to build friends and make CEO friends and people who work at the companies to build relationships so I can learn more about the businesses that I bring to you. That's why I do all of this posting on Instagram and everywhere else, in case you wonder why I did that. It doesn't get you any views, but it does make contacts. All right. How long have we got? 3 minutes. Okay, put it onto the Facebook group as well. And then we've got to do Mercury as well. But I'll do that once the call starts. I'll be quiet and listen in. Right, okay, so over on the extra channel, there's 33 of you. On the main channel, there's 15. There's more people watching Mercury tonight, which is interesting. We will do Mercury in a few moments. I will promote that. So if you want to go and vote, you can. 3 minutes. Let's see if I can start doing Mercury. MRCY. Here we go. MRCY. Bugger me. Missed it. I've got time, I think, to get this done. MRCY. Live now on YouTube. Join the investors. Why watch alone? There you go. And let me give you that. I'm going to get it done before the main before it starts. MRCY. Martyn. Whoops. Lucas Investor. There you go. How long have I got now? 2 minutes. Perfect. Get that done. Right, I run a poll as well on X. I've given you the link already. Go and check, and you can see the poll. The poll is coming up now for both of these stocks. Is this a buy, hold, or sell for you? Please vote in X poll. Okay, here we go. The options are buy, hold, sell, or undecided. We'll run it again, the same as the other one, for 7 days. And there we go. Right, the systems are all in place now on X. We'll put the same thing on Facebook. There it is. And on, how long have I got now? 1 minute. Okay. Okay, 1 minute to go. Fantastic. They'll typically be 1 or 2 minutes late. That is typically normal, so I'm not worried about that. But I'll be on time anyway. Can't believe I got both of these done. I love it. Okay. There you go. Mercury polls are out everywhere. You can vote on all of these things. It's all good. Share group. Okay. I'm now going to listen in to the call and see if they're ready. I doubt if they are. They never go on time. No one ever goes on time. They're always 2 minutes late, but I'll be ready for them when they do. Right. So, Mercury, we've got... we're about to start. So let's bring up the audio. Let's have a listen in. Let's have a listen in. Mercury's half an hour. On the main channel, we've got Achieve. Let's have a look. Right, still playing audio. We're any moment to go now. Let me just keep listening in. Okay. A bit quiet. Let me turn the audio up a bit. So, Achieve Life Science is about to go live. They're playing background music. Everybody over there on the extra channel, you're watching Mercury. There's half an hour to go before your call starts. So you could either join us here on the main channel or stay where you are. The links for both channels are in the chat or on the homepage of each channel. Achieve Life Sciences, we're still waiting for the call to begin. If you've just tuned in, please do click subscribe and ring the bell. and tap the like button. That would be absolutely fantastic. They're still playing audio. We're listening in everywhere. We're all good. Thank you ever so much, everybody on Mercury. We've got half an hour before that call begins. So you've got the chart on the screen. Listening in again to Achieve. Still playing music. Typically 1 or 2 minutes late. That's how these things go. When they start, I'll let you know. All the audio is good. We're ready to rock and roll. Welcome, everybody. So, all right, let's listen in again. If you're over on the extra channel, your earnings.
And as a reminder,
here we
this
go.
Conference is being recorded. I would now turn the call over to Nicole Jones with Investor Relations. Thank you, Nicole. You may begin.
Thank you, operator. Good afternoon, everyone, and thank you.
So everybody on the extra channel, you are listening to Achieve Earnings at the moment, but in a few moments, in half an hour,
President and Chief Medical Officer, and
your call, Mercury, will start, and I will stop sending you this audio, and you will hear your own audio. So stand by for your earnings. It's in 30 minutes.
That today's conference call contains forward-looking statements based on current expectations. These statements are only predictions, and actual results may vary materially from those projected. Please refer to Achieve documents available on our website and filed with the SEC concerning factors that could affect the company.
In 30 minutes.
I'll now turn the call over to John.
Thank you, Nicole, and thanks everyone for joining us. We are excited to provide an update today on the tremendous progress we have made on the cytisinicline development program from both the clinical and regulatory fronts. In recent weeks, several key accomplishments have provided excellent momentum for furthering our mission of bringing cytisinicline to the millions of people who are battling nicotine dependence. Furthermore, we are pleased with the recent refinancing, which will propel us towards our first NDA submission for smoking cessation, which remains on track for filing in the first half of 2025. We will go through each of our achievements in more detail, but briefly, in the last few months, we have received FDA Breakthrough Therapy designation for cytisinicline for treating e-cigarette or vaping nicotine dependence. We initiated and gained significant traction on the ORCA-OL trial, evaluating the long-term safety effects of cytisinicline. We were added to the U.S. Russell 3000 and Russell Microcap indexes, and we refinanced our outstanding debt agreement with SVB. We are very pleased with this progress and the support we are receiving from the scientific, regulatory, and financial communities that are setting up cytisinicline for great success.
If you're on extra, you are listening to another call. Mercury call will start in 20 minutes.
Cindy?
Stand by.
Thank you, John. Recently in July, we were very pleased to have FDA grant cytisinicline Breakthrough Therapy designation for the vaping cessation indication. Breakthrough Therapy designation is important because it offers access to an FDA cross-disciplinary project management team for interactive communications with senior managers and reviewers at FDA. This will be beneficial in completing the regulatory requirements necessary for expanding cytisinicline treatment as the first approved pharmacotherapy in treating nicotine dependence for e-cigarette cessation, not only in adults, but also possibly for an adolescent vaping population. The public heightened issues surrounding the increasing e-cigarette use in young adults and adolescents justifies the need for urgent action towards a solution. Breakthrough Therapy designation will help to accelerate our proposed clinical program with more active FDA input. Although there is a general understanding that using e-cigarettes is safer alternative to smoking combustible cigarettes, this has led to the perception that e-cigarettes or vaping nicotine is safe, resulting in a new, younger generation becoming addicted to nicotine. The developing body of scientific and medical evidence is now showing that long-term e-cigarette use can be harmful and may lead to more severe addiction due to the high nicotine levels in vapes. Long-term e-cigarette use may also contribute to potential lung injury, asthma, COPD, and negative cardiovascular effects. At the annual March meeting of the Society for Research on Nicotine and Tobacco, guidance from experts in the field was presented based on Project Vector, which stands for Vaping and Electronic Cigarette Toxicity Overview and Recommendations. Several recommendations were presented, which included people who do not smoke should not use nicotine e-cigarettes, and people who use e-cigarettes should avoid long-term use of e-cigarettes. These recommendations were based on reducing long-term respiratory injury, adverse effects on the cardiovascular system, and exposure to cancer-causing chemicals in vaping aerosols, as well as preventing sustained nicotine dependence. Breakthrough therapy was developed to expedite the clinical development of products that treat serious conditions, which there is an unmet need, and when there is preliminary evidence demonstrating potential benefit. Our justification was that long-term vaping may lead to serious conditions, that there are no approved treatments to assist people in quitting, and that the positive results we observed in our ORCA V1 trial showed the potential benefit.
On the extra channel, your earnings is 20 minutes away. You are listening to the main channel. Please stand by.
Us breakthrough status. We've already submitted a request for a Type B meeting with FDA that will start interactions with their cross-disciplinary project management team, and will also serve as an end-of-phase 2 meeting for gaining agreement on the development plans for a vaping cessation indication. Moving on to our lead indication, smoking cessation, and the status of the long-term cytisinicline exposure trial. In May, we initiated the open-label ORCA-OL trial, which is collecting long-term exposure data on cytisinicline. ORCA-OL is recruiting subjects who participated in our previous Phase 2 and Phase 3 trials. We are pleased to report that all 29 clinical sites are actively enrolling subjects. Enrollment has been going very well, and more than half of the proposed 650 participants have already been enrolled onto the study. Over the next few months, we will be monitoring the treatment discontinuation rate, which is currently very low. The enrollment objective is to ensure that we achieve the required 300 subjects exposed for 6 months at NDA submission. Providing that subject retention rates continue to remain high, we anticipate possibly closing out enrollment in advance of the 650 enrollment cap, possibly within the next 2 months. As a reminder, the primary analysis for this study will be to evaluate the rate of serious adverse events thought to be related to cytisinicline treatment. And we have engaged the same independent data safety monitoring committee who had oversight of ORCA-2, ORCA-3, and ORCA-V1 studies to oversee and review safety events during this open-label study. We plan to provide general summary updates following the completion of these committee safety reviews, with the first meeting expected to occur in the fourth quarter, and subsequent meetings to be determined by the committee members thereafter. Based on our agreement with FDA, the necessary clinical data from ORCA-OL remains on track to support an NDA submission during the first half of 2025. As we continue our monitoring of subjects being treated in the open-label study and their exposure timing, we can further refine our guidance in the future on the NDA submission timing. Overall, I'm very pleased with the rapid progress we have made both in the clinic and with regulators since our last update. I'll now turn it back over to John.
Thanks, Cindy. Turning now to the financial updates, we recently completed a $20 million debt refinancing with Silicon Valley Bank that refinanced our existing debt facility and extended the maturity date from August 1st, 2024 to December 1st, 2027. This refinancing
Please
continues
stand
our
by on
partnership
the extra
with
channel,
SVB
Mercury
and
earnings
further
in
solidifies their
18
confidence in
minutes.
Achieve
You are
and
listening to the main
cytisinicline
channel right now.
program.
Links in the
The
chat.
refinancing also lowers our cost of capital, extends our cash runway, and provides access to additional capital as cytisinicline moves through the regulatory approval process with FDA. I'll now hand the call over to Jerry for additional financial updates. Jerry?
Thank you, John. Good afternoon, everyone. As John mentioned, we successfully entered into a debt refinancing agreement with SVB that provides for up to $20 million in availability. Under the terms of this new agreement, the $20 million term loan is divided into 3 tranches. The first tranche of $10 million was received at closing. The second tranche of $5 million will be available upon FDA acceptance of the new drug application for cytisinicline, and the final $5 million tranche will be available subject to SVB's discretion and credit committee approval. The outstanding principal will accrue interest at a floating rate per annum equal to the greater of 7% and the prime rate minus 1%. The loan facility includes an interest-only period through December 31st, 2025, followed by 24 monthly payments of principal plus interest to the maturity date of December 1st, 2027. Upon achieving certain regulatory and financial milestones, there is an option for a 6-month extension to the interest-only period and maturity date. Furthermore, the initial outstanding debt, including principal and accrued interest, subject to certain terms and limitations, can be converted into Achieve's common stock at SVB's discretion before repayment at a conversion price of $7 per share. Subsequent tranches may be converted based on a 150% premium to Achieve's stock closing price at that time, with a minimum price of $4.85 per share. Importantly, while the loan is outstanding, SVB cannot short sell or hedge Achieve's stock. We can repay and retire all outstanding convertible debt at any time before conversion by paying a premium based on the repayment date. Let's now turn to the second quarter financials. As of June 30th, 2024, the company's cash equivalents, restricted cash, and short-term investments were $61.3 million, as compared to $66.4 million for the prior quarter. We believe our current cash balance is sufficient to provide
Mercury,
a runway
14 minutes ago before your earnings begins. Thank you. You're listening to the main channel at the moment.
The company incurred a net loss of $8.5 million for the
Links
quarter
in the
ended
chat.
June 30th, 2024, as compared to a net loss of $8.2 million for the same quarter in the prior year. Net loss for the 6 months ended June 30th, 2024, decreased to $15 million, as compared to $17.2 million for the same period in 2023. We expect our quarterly operating expenses will increase as we progress forward with the ORCA-OL trial. I'll now turn the call back over to John.
Thank you, Jerry. Smoking remains the leading cause of preventable death, killing over 8 million people globally each year, including nearly 500,000 in the U.S. Smoking is recognized as a major cause of various cancers, of respiratory disease and lung injury, cardiovascular disease, type 2 diabetes, and dementia. We believe that cytisinicline can help address the root cause of these disorders and have an impact through disease reduction. Focusing on COPD as an example, according to the CDC, approximately 80% of COPD is caused by smoking, and 38% of the 16 million U.S. adults with COPD currently smoke. If we are able to help patients with COPD quit smoking, there is potential to significantly reduce the number and severity of exacerbations, and in the long term, potentially reduce the number of COPD patients. In addition, vaping continues to be an emerging health crisis, with an estimated 11 million adults and 2 million middle and high school students using e-cigarettes in the U.S. The long-term health effects from inhalation of vape products that are heavily unregulated is of utmost concern. These statistics highlight the urgent need for effective cessation treatments, especially since no new products have been FDA approved in nearly 20 years. There are no FDA approved treatments for e-cigarette cessation, and concern is growing as evidence emerges on their long-term use. Cytisinicline has the potential to be a first-in-class treatment to address the unique challenges of quitting vaping. Currently, there are more nicotine products available than any time in history, which has been fueled by continued innovation in ways to deliver nicotine to consumers.
Mercury information on the screen, 12 minutes to go on extra.
Products like Zyn, which has seen triple-digit growth in recent years. Regardless of the nicotine delivery mechanism, we believe cytisinicline can play a critical role in addressing this health crisis and achieving better long-term outcomes for patients. We've had a great first half of 2024 and expect the momentum to carry forward as we look to our objectives for the remainder of the year. We are now focused on closing out enrollment and continuing our focus on monitoring of subjects in the ORCA-OL trial, continuing preparations for the NDA submission, which remains on track for the first half of 2025, and conducting the end-of-phase 2 meeting with FDA for the vaping cessation indication. The support that we expect to receive from FDA, having a breakthrough status, should further de-risk the program and expedite our ability to move through the regulatory approval process. We look forward to providing further updates on the vaping program after our end-of-phase 2 meeting with the agency has been conducted. In closing, we are excited about what lies ahead for the company in the coming months. We greatly appreciate the dedication of our trial participants and healthcare providers and the continued support of our shareholders. We remain committed to advancing our mission and in our belief of cytisinicline's potential to help millions of people overcome nicotine dependence. In parallel, we believe strongly that we can create shareholder value by bringing to market the first new FDA-approved nicotine dependence product in nearly 2 decades, with the potential to become the market leader and generate substantial revenues. Thank you for joining us today. We look forward to continuing our progress, and we will now open the line for questions.
Okay, if you are listening on the Extra channel, you are listening to Achieve Life Sciences. Your earnings will start in 10 minutes. And at the end of this channel on Achieve Life Sciences, it will send you over to join the investors on the Extra channel for Mercury. Stand by.
It may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions.
Please tap the like button on both channels, please, and consider subscribing. Thank you.
And the first question comes from the line of Thomas Flatten with Lake Street Capital. Please proceed with your question.
Yeah, good afternoon, everybody. Congrats on all the progress. Cindy, a couple questions for you. You mentioned the retention rate in your prepared comments. I was wondering if you could share with us what that is. And then also, can I infer from your comments around potentially ending enrollment sooner that enrollment pace is accelerated?
Well, the enrollment actually started off in an accelerated manner, and we don't give exact numbers, but given that we have over half of the intended 650, kind of tells you how well that enrollment has gone over the last couple of months. Our most important thing now is looking at the discontinuation rate, and if the discontinuation rate remains low, and it's like single digits, then we're looking at how many subjects we really need to enroll to get then 300 at 6 months and 100 at 1 year. We certainly don't need 500 to 600 subjects at 6 months and 1 year. So that's where we're looking at when do we then look at closing enrollment early to basically save costs on the trial.
Got it. And then once you have the 300 patients with 6 months of data, are there any other gating items that we should be thinking about as it relates to completing the NDA package, or is that pretty much set and you're waiting to staple this kind of to the back of it?
No, that is the last piece for the ClinReg for the NDA. I mean, obviously, once you get to 6 months, you have to monitor all the data, collect it, lock the database, write it up. So there is that period of time. But then you feed or kind of thread the results of that long exposure into the ISS documents that will be ready and waiting for that last piece of information for the NDA.
Got it. Appreciate it. Thanks so much.
9 minutes to
And the next
go
question will
on
come from
Extra
the line
Channel
of Justin Walsh with Jones Trading.
for
Please proceed with your
Mercury earnings. You are listening to the main channel at the moment.
Can you expand on the potential advantages of having vaping cessation specifically on your label versus broader labels focused more generally on nicotine?
Yeah, thanks for the question, Justin. So, with respect to the labeling, I think the core indication will be smoking cessation for nicotine dependence, and there can certainly be some off-label usage in other forms of nicotine addiction. But I think with respect to vaping in particular, we think it'd be very powerful to be able to promote directly to e-cigarette users, given the size of that market. We look at smoking overall here in the U.S., there's approximately 28 million adult smokers, and the vaping indication is now 11 million and growing. So it is a very, very large segment, and I think to be able to promote as the first and likely only treatment there, we think would be very powerful.
Great, thanks. And a quick follow-up. I don't know how much you can actually say, but I was wondering if there's any color you can provide on potential discussion points leading into your end of phase 2 meeting with the FDA.
Do you want me to take that, John?
Yes, Cindy.
Yeah. So for the end of phase 2 meeting, we'll have a list of questions that will all be based that we have smoking cessation as our first indication. The biggest one will be that we only need one phase 3 because of the phase 2 is a supporting trial. And there'll be other discussions as far as what do we need and any additional safety data, because we'll have all the long-term exposure from this open label study that should be appropriate for the vaping cessation as well as the smoking cessation indication. So we'll get some good clarity and agreement on what is required.
Mercury,
so
5 minutes to go.
And we can actually
You are listening to the main channel,
supplemental NDA faster.
Achieve Life Sciences.
Great, thanks for taking the questions.
And the next question comes from the line of Frank Brisebois with Oppenheimer. Please proceed with your question.
Hi, this is Dan on for Frank. Thanks for taking our questions. Just quickly, one regarding the open label ORCA. We know this is a safety trial, but will you be looking at any efficacy in this trial? Is there anything from an efficacy perspective that you could get from this trial potentially for labeling purposes? Any thoughts there?
Yes, we will be looking at efficacy, especially for retreatment of individuals that have already been treated with cytisinicline, as well as individuals that were originally on the placebo, seeing it for the first time. FDA definitely views this as a primary safety study, so I'm not sure, because it's not a randomized study, that we're going to get any of that in the label, but certainly we will be publishing it, and we are collecting efficacy.
Thank you. Thanks for taking my question.
And the next question comes from the line of John Vandermosten.
4 minutes to go on the Extra Channel for Mercury. We're just listening to the main channel at the moment, Achieve Life Sciences.
What your screening success rate is for the OL trial, and then also on that same theme, have you been able to enroll a lot of the 12-week cytisinicline exposure patients and enroll a bunch of those, or has it been pretty even between the patients that were in the placebo, the 6-week and 12-week?
Sure. I mean, the one nice thing is the screen fail rate. We look at screen fails. The screen fail rate has been half or even lower than what we normally see, which, we kind of hopefully expected, because most of these individuals had already screened through and were on the previous ORCA studies. So we had hoped the screen fail rate would be low, which it is. Interesting, all of the phase 3 and even the phase 2 vaping study, 2/3 of the individuals had already been treated with cytisinicline. So it's the same sort of 2/3 of the individuals on the open label have already been treated with cytisinicline coming in. So we are getting some placebos, which is great, because then that means we have more subjects overall treated with cytisinicline. And then we also have those coming in that helps us get to the 6 months and 1 year sooner.
Okay, great. And when we look at the breakthrough therapy designation that was granted, and you kind of look at the way that could help you, I mean, I guess I could see three ways where it might help accelerate the trial pace, reduce the cost, or increase the likelihood of ultimate approval there. Where do you, in those three areas, what do you see as the biggest help from this FDA program?
I think both right now, quicker agreement to what the phase 3 clinical trial will look like. And then once that we're getting through that trial, then negotiating a rolling submission. And then obviously upon having it
3 minutes to go for Mercury.
Review. So
it may be 1 or 2 minutes late. They always
time
are.
Off through all aspects of the development.
Great. And last question, it was still on the vaping theme. You had some monies coming in from the grants. Have we received that all yet, or are there still funds that are going to be offsetting some of your expenses in the future? How does it look on that side of things?
Yeah, on the grant side of things, the vaping phase 2 trial, which is where the grant was directed previously, we have received all the funding related to that, so that's now complete. But we'll continue to look for future opportunities, in particular, given the strong support we've received from NIH and NIDA historically.
Great. All right. Thank you, Jonathan. Appreciate it.
And the next question comes from the line of Michael Higgins with Ladenburg Thalmann. Please proceed with your
2
question.
2 minutes to go for Mercury. There may be a 2-minute delay.
Hey guys, this is Farhana on behalf of Michael. Congratulations from us on your progress this quarter. So one question from us. Last week, JAMA published a series of papers on vaping. And following the recent breakthrough therapy designation, are you hearing any activities from the FDA, the NIH, or any other government agencies that may support your development in the vaping indication?
Yeah, thanks for the question, Farhana. We're continuing to track all the activities going on across the spectrum, in particular with respect to vaping in particular. So we do expect more support on that front. I think the biggest piece that we're looking to here in the near term would be through the breakthrough designation, now that we have that in place with FDA. And then, as I just mentioned previously, continuing to look to see if there's additional support we might be able to garner.
Mercury earnings, 1 minute to go. Stand by.
The two most critical areas. And I think when you look across the overall landscape of what's being done, in terms of other existing smoking cessation products being studied across the vaping indication, there really isn't too much happening in that space. So we think, driving this program forward quickly, can really move the needle in a category that has no approved products currently.
Thank you.
And the next question comes from the line of Ilya Zubkov with Freedom.
Okay, we're on standby now for Mercury earnings. Could be 1 or 2 minutes late, but we are listening in.
Thank you for taking my question. My first question is on the ORCA-OL trial. So given the swift recruitment of trial participants, do you plan to publish any interim results from the trial this year?
Publish, no. When we go and have and complete our data safety monitoring committee, we will at least give an update as far as where we are with the safety monitoring in general. But right now, not publishing it.
Okay, thank you. And I have another one on the...
We're on standby now for Mercury earnings. Please stand by.
I know that it is difficult to discuss the details before meeting with FDA, but as the high risk of vaping for adolescents was mentioned, are you considering targeting this population in e-cigarettes study as well?
Yes, but more in a post-marketing kind of arena. So the most important thing for us is to complete a phase 3 for vaping cessation in young adults. But like our other studies, young adults we define
Mercury
as 18 years and older. So we will have younger adults and looking at that as well for a future potential adolescent program.
Great, thank you. I pass the line.
Stand by, Mercury on the Extra
And the next
Channel.
question is a follow-up from Thomas Flatten with Lake Street Capital. Please proceed with your question.
Hey, John or Cindy, I just wanted to confirm. So, assuming you have a good end of phase 2 meeting with FDA, around the end of the year, what would your intentions be with respect to actually starting a study? Would that be, done under your own account, or would you anticipate working with a partner on that? And what would timing be? I'm just thinking from a modeling perspective more than anything right now.
Yeah, thanks for the question, Thomas. I think on
Stand by, Mercury. We're just waiting for the call to start.
The most important piece is getting through the end of phase 2 meeting, really understanding what's required going forward, and seeing what sort of support we might be able to garner from FDA to accelerate that. I think with respect to starting a new trial, it's really probably more middle of next year at the earliest. The focus is going to continue to be getting that NDA on file first half of 2025 and driving the core indication forward to approval.
Stand by for Mercury earnings on Extra. Imminent.
Thank you. At this time, we have reached the end of the question and answer session. Now I'd like to turn the call back over to the management team for any closing comments.
Thanks again, everyone, for joining us today. We look forward to providing additional updates as we progress through the balance of this year and drive the program forward towards NDA submission in the first half of 2025. So again, appreciate the continued support and have a great afternoon.
Okay, folks.
And ladies and gentlemen, that does conclude today's teleconference.
Okay, we're now starting the earnings on the Extra Channel for Mercury. Stand by.
Delivering predictable performance, building a thriving growth engine, expanding margins, and driving improved free cash flow. And third, expectations for our performance as we enter FY25 and longer term. Then I'll turn it over to Dave, who will walk through our financial results. Before jumping in, I'd like to thank our customers for their collaborative partnership and the trust they put in Mercury to support their most critical programs, and our Mercury team for their dedication and commitment to delivering mission-critical processing at the edge. One other note, I'd like to thank Nelson Erickson for his contributions to Mercury over the years. I know many of you have interacted with Nelson on the investor relations front. Nelson is elected to pursue a new opportunity outside of Mercury, and we wish him well in his future endeavors. Please turn to slide 4. In FY24, we made considerable progress addressing transient challenges in the business. As we enter FY25, I'm optimistic about our strategic positioning as a leader in mission-critical processing at the edge and our expectations on delivering predictable organic growth with expanding margins and robust free cash flow. Our Q4 and full-year results were in line with or ahead of our expectations. Q4 bookings of $284 million and $1.02 billion for the full year, in line with our guidance of $1 billion and representing a FY24 book-to-bill of 1.22. Q4 revenue of $249 million and $835 million for the full year, above the midpoint of our guidance. Q4 adjusted EBITDA of $31 million, up 42% year over year. And Q4 free cash flow of $61 million and $26 million for the full year, keeping with or exceeding our guidance of free cash flow positive for the fiscal year. Q4 free cash flow was up $58 million year over year and represents the highest quarterly free cash flow in the company's history. We ended the fourth quarter with $181 million of cash on hand after paying down $25 million of debt. These Q4 results reflect solid progress in each of our 4 priority focus areas, with highlights that include retiring risk across our remaining challenge programs, most notably executing the plan on the return to initial pilot production on our Common Processing Architecture area, expanding our record backlog to over $1.3 billion, up 16% year over year, additional streamlining of our operations, enabling increased positive operating leverage as we return to organic growth, and reversing the multi-year trend of growth in working capital, with net working capital down 15% year over year and sequential reductions in inventory and unbilled receivables. With this progress in FY24, we are entering FY25 with a clear path toward delivering predictable organic growth, expanding margins, and improved free cash flow. Please turn to slide 5. Following those introductory comments, I'd like to spend time on each of our 4 focus areas, starting with our first focus area, delivering predictable performance. In the fourth quarter, we delivered improved operating performance and were able to more effectively mitigate what we believe to be the transitory challenges that have obscured the underlying performance of the business. In Q4, we recognized approximately $16.2 million of items that we believe are transitory, down from $39 million in Q3, including $9.7 million of net EAC change impact across our portfolio, $2.9 million of inventory reserves and scrap, and $3.6 million associated with contract settlement reserves. These items impacted Q4 revenue by approximately $9.7 million, gross margin by approximately $12.6 million, with the remainder impacting operating expenses. The approximately $9.7 million of net EAC change impact is a 38% reduction from what we experienced last quarter and consisted of approximately $4.4 million from our challenge programs and approximately $5.3 million spread across the remaining programs in our portfolio. Although still greater than we would like to see, the magnitude of these items is the lowest in 4 quarters and reflects the progress we are making in driving toward predictable execution and steady growth. As shown on slide 6, with respect to the challenge programs, since the end of the third quarter, we progressed by completing, exiting, or retiring risk on 3 additional of the original 19 programs. We believe we have now retired risk on 13 of the original 19 challenge programs that have materially contributed to earnings volatility in recent quarters. For the 6 remaining programs, 2 are nearing completion and represent ordinary course risk going forward. The other 4 remaining programs are associated with a common processing architecture. As I mentioned, we have successfully executed on our return to initial pilot production in our common processing architecture area. We're in the final phases of reliability testing with significant risk retired and are on a deliberate path to ramp up toward full rate production in the first half of the fiscal year, leveraging additional capital equipment and trained resources that we have in place. Given the progress in FY24, we will no longer separately address the challenge programs going forward, but we will keep you informed with regard to progress on our common processing architecture. Please turn to slide 7. Turning now to the second focus area, driving organic growth. Bookings for the quarter were $284 million, resulting in a 1.14 book-to-bill. Our backlog, now at a record $1.3 billion, is up 16% year over year. Notably, when we look at FY24 bookings, approximately 80% of our firm fixed-price bookings are production in nature, which we believe is a good leading indicator that the mix shift toward production is progressing in our firm fixed-price portfolio. Some wins in the quarter worth noting. A large production order from a prime contractor for Mercury Processing Solutions to be integrated on a key U.S. Air Force program of record. Multiple large production orders for processing solutions employed in air and missile defense systems for U.S. and international customers, including some which are actively engaged in Ukraine, and others which will provide critical capability in support of NATO ongoing operations in Europe and elsewhere. Multiple production orders for F-35 related electronics content, cutting across various subsystems in both our processing technologies and signal technologies business units. And a $13.2 million cost-plus development award from the Office of Naval Research to advance sensor processing technologies, which will enable radar and EW capabilities to be designed on much shorter timelines, by increasing the modularity of components at the chip level and leveraging the latest commercial chips from major semiconductor providers within a smaller and lighter footprint. These awards are important not only because of their value and impact on our growth trajectory, but also because they reflect our customers' trust in Mercury to support their most critical franchise programs. We know from engagements with our customers that our unique capabilities providing mission-critical processing at the edge align well with our customers' priorities and strong demand in growth markets, including sensors and effectors, electronic warfare, avionics, and C4I. Please turn to slide 8. Now turning to our third priority focus area, expanding margins. We believe FY24 was an unusual transitory year where we delivered margins well beneath our targets. These shortfalls were primarily driven by the previously discussed impacts that we view as transitory and negative operating leverage from relatively low production volume, largely tied to development program delays. Looking forward, to achieve our adjusted EBITDA margin targets, we are focused on the following levers: executing on our development programs and minimizing cost growth impacts, getting back toward a more historical 20/80 mix of development to production programs, driving organic growth to generate positive operating leverage, and achieving cost efficiencies. I've discussed on this call our program execution and cost growth containment efforts along with our organic growth efforts. Regarding cost efficiencies, as mentioned in prior calls, we implemented a series of cost reduction actions during FY24 as we streamlined and realigned our organization structure, resulting in significant cost savings previously announced. In Q4, we completed top-to-bottom leadership selection for the corporate reorganization initially announced in January, organizing our U.S.-based business units into 2 product business units and an integrated processing solutions business unit, and centralizing our engineering, operations, and mission assurance functions. Additionally, we stood up an advanced concepts group that's focused on advanced technologies, innovation, and strategic growth pursuits. With this significant effort behind us, we exited FY24 with a streamlined cost structure, an integrated organizational construct, and a strong leadership team that is well poised to build on our momentum coming out of FY24 and drive improved performance toward our targeted business profile. Please turn to slide 9. Finally, turning to our fourth priority focus area, improve free cash flow. We continue to make progress in reducing net working capital, which is down $93.3 million year over year after years of expansion. Inventory is down sequentially by $8 million from $343 million in Q3 to $335 million in Q4. Notably, while inventory is flat year over year, WIP is up 44% year over year from $82 million to $118 million, reflecting an increased mix of inventory progressed toward delivery. Unbilled receivables are down year over year $79 million or 21%, driven by Q2, Q3, and Q4 billings, which were the 3 highest billing quarters on overtime revenue contracts in the company's history. This record level of billings reflects our relentless focus on progressing our programs in order to deliver for our customers and in turn invoice and collect cash, leading to the free cash flow record performance in Q4. We believe the operational process rigor we've implemented in FY24 related to program execution and hardware delivery, just-in-time material, and appropriately timed payment terms will lead to continued reduction in working capital and improved free cash flow performance going forward. Please turn to slide 10. Entering FY25, I have high confidence in our team, our leadership position in delivering mission-critical processing at the edge, and our expected ability over time to deliver results in line with our target profile of above-market top-line growth, adjusted EBITDA margins in the low to mid 20% range, and free cash flow conversion of 50%. Although we will not be providing specific guidance this early in the year for FY25, I will provide the following color. In FY25, we expect to make further progress on the two primary challenges we have been tackling over the last year, specifically high working capital and the high mix of development programs, which we expect to see reflected in our FY25 financials in the following two ways. First, as we continue to focus on bringing down working capital, we expect to allocate meaningful operational capacity to advance programs with large unbilled receivable balances, which generates cash but relatively low revenue, given that on many of these programs, a large percentage of revenue has been previously recognized. As a result, we expect our top line for FY25 to be relatively flat year over year, with the first half in line with last year and an increase in run rate as we exit the fiscal year and begin to allocate more operational capacity away from legacy programs with high unbilled balances toward production programs. Second, while we have made significant progress on development programs across our portfolio, our current backlog margin is lower than what we expect to see on a go-forward basis, driven primarily by a small number of low-margin development programs and programs that incurred adverse EAC adjustments in FY24. Given that a large percentage of our backlog converts over the next 12 months, although we expect low double-digit adjusted EBITDA margins overall for FY25, we expect adjusted EBITDA margins to start off in the high single digits for the first half of the year and then expand in the second half as we complete these lower margin development efforts and continue to shift our mix toward production. Finally, given our recent strong free cash flow performance in Q4, we're expecting to be cash flow positive again in FY25, with second half free cash flow higher than the first half. In summary, given the operational improvements over the last 12 months and our momentum coming out of Q4, I expect that our performance in FY25, in particular our exit run rate, will represent a positive step toward our target profile. As we progress through the first half of the year, I look forward to providing additional insights relative to our expectations for second half and full year performance. With that, I'll turn it over to Dave to walk through the financial results for the fourth quarter and fiscal year 2024, and I look forward to your questions. Dave?
Thank you, Bill. Our performance in Q4 was in line with our expectations, and I will echo Bill's comments that the actions we've taken throughout the year have supported the improved performance that we delivered during the fourth quarter, and highlights the initial progress that we've made given our objective to transition the business toward delivering predictable performance, building a thriving growth engine, expanding margins, and driving improved cash flow. We continue to expect a resource shift toward follow-on production awards that in turn, we believe will begin to rebalance our portfolio more heavily toward higher margin, predictable production programs, as well as consume further existing inventories. We are also making strides in releasing working capital, especially related to unbilled receivables. We expect to see these transitions become more apparent in our financial results during fiscal year 2025. Progress in our 4 priority focus areas is highlighted by a few key milestones that we achieved during the quarter. These milestones included our ability to retire risk across the majority of our remaining challenge programs, expanding our record backlog to over $1.3 billion, continuing to streamline our operations to drive margin expansion, and reversing the multi-year trend of growth in working capital. With that, please turn to slide 11, which details our fourth quarter results. Our bookings for the quarter were $284 million, with a book-to-bill of 1.14, yielding a backlog of $1.3 billion, up $186 million, or 16% year over year. Revenues for the fourth quarter were $249 million, down $5 million, or 2% compared to the prior year of $253 million. This represents an improvement over our earlier outlook that we described during our third quarter earnings call, driven by material receipts scheduled for Q1 arriving in Q4. As you may recall, we maintained a wide range in guidance as there were uncertainties in the fourth quarter that could have resulted in adverse impacts driving our performance to the lower end of our range. And conversely, the timing of material receipts planned in the first quarter of fiscal 2025 would drive our results to the higher end of our range. As Bill noted, we experienced approximately $10 million of net EAC change impacts affecting revenue in the quarter as compared to approximately $16 million in the third quarter of fiscal 24. The $10 million, which was the lowest net EAC change impact in the last 5 quarters, was comprised of approximately $4 million related to our challenge programs and nearly $6 million spread across multiple other development and production programs. The $4 million net EAC change impact related to our challenged programs was largely tied to the 4 programs associated with the Common Processing Architecture, representing approximately 65% of the impact. As Bill stated, we believe we have successfully executed on our return to initial pilot production. We are in the final phases of reliability testing, and we've retired significant risk in this area as we progress toward full rate production. Of the nearly $6 million of net EAC change impact related to the large number of other development and production programs, we realized ordinary course execution challenges across the program portfolio. Gross margin for the fourth quarter increased to 29.5% from 26.6% in the prior year. Gross margin grew during the quarter primarily due to lower net EAC change impact of approximately $19 million as compared to the prior year. Operating expenses increased approximately $5 million year over year, primarily due to higher SG&A expenses of approximately $11 million and increased restructuring and other charges of $6 million as compared to the prior year. These increases were partially offset by lower R&D expense of approximately $8 million, driven by our workforce reductions. The increase in SG&A was primarily driven by higher stock-based compensation expense of approximately $8 million in the current quarter as compared to the prior year. In the fourth quarter of the prior year, there were forfeitures of nearly $7 million from our former CEO's stock-based compensation. The fourth quarter of fiscal 24 also included $3.6 million of contract settlement reserves. The increase in restructuring and other charges was driven by the previously announced workforce reduction that eliminated approximately 100 positions, resulting in restructuring and other charges of approximately $7 million in the current quarter. The headcount savings, combined with other non-headcount savings, including discretionary and third-party spend primarily within R&D and cost of revenues, are expected to yield annualized savings of approximately $15 million, a portion of which is expected to be reinvested in the business, with the remainder supporting improved profitability and operating leverage for our 2025 fiscal year. GAAP net loss and loss per share in the fourth quarter were $10.8 million and 19 cents, respectively, as compared to GAAP net loss and loss per share of $8.2 million and 15 cents, respectively, in the prior year. The decrease in year-over-year earnings is primarily a result of higher operating expenses of $5 million, driven by SG&A, restructuring, and other charges. The decrease was also impacted by higher non-operating expenses, including net incremental other expense of approximately $2.7 million and interest expense of $2 million. These decreases were partially offset by higher gross margin of approximately $6 million, driven primarily by lower net EAC change impacts during the quarter as compared to prior year. Adjusted EBITDA for the fourth quarter was $31.2 million compared to $21.9 million in the prior year. Adjusted earnings per share was 23 cents as compared to adjusted earnings per share of 11 cents in the prior year. The year-over-year increase was primarily related to lower loss from operations in the current year as compared to the prior year. Free cash flow in the fourth quarter was an inflow of $61.4 million as compared to an inflow of $3.8 million in the prior year. The increased free cash flow was primarily driven by incremental cash provided by operations of $59 million in the current year as compared to the prior year. Turning to our full year results on slide 12. Fiscal year 2024 was another solid year for bookings. Our book-to-bill was 1.22 compared to 1.10 in fiscal year 2023, yielding a backlog of over $1.3 billion. Fiscal year 2024 revenues were $835 million, down 14% compared to the prior year. Our fiscal year revenue decline was largely the result of net EAC change impact of $73 million and the deliberate pause on Common Processing Architecture production. Gross margin for the fiscal year 2024 decreased to 23.5% from 32.5% in the prior year. Gross margin contracted by approximately 900 basis points, primarily as a result of net EAC change impacts and incremental manufacturing adjustments, especially as related to inventory reserve, warranty expense, and scrap. Operating expenses for the fiscal year increased approximately $5 million compared to the prior fiscal year, primarily due to higher restructuring and other charges, as well as higher SG&A expenses as compared to the prior year. These increases were partially offset by decreases in R&D and amortization expenses as compared to the prior year. GAAP net loss and loss per share in fiscal 24 were $137.6 million and $2.38 respectively, as compared to GAAP net loss and loss per share of $28.3 million and 50 cents respectively in the prior year. The year-over-year decrease was a result of approximately $73 million of net EAC change impact, additional manufacturing adjustments, and contract settlement reserves. GAAP net loss was also impacted by the temporary volume shift in revenues as we align our operating cadence with prudent working capital management. These factors were partially offset by the incremental tax benefit year over year. Adjusted EBITDA for fiscal year 2024 was $9.4 million compared with $132.3 million in the prior year. The decrease was primarily related to lower gross margin and reduced operating leverage. Free cash flow for the fiscal year was an inflow of approximately $26.1 million compared to an outflow of $60.1 million in the prior year. The increase in the current year was primarily driven by the progress we've made in converting our unbilled and trade receivables to cash. Slide 13 presents Mercury's balance sheet for the last 5 quarters. We ended the fourth quarter with cash and cash equivalents of approximately $181 million after making a $25 million payment against our revolver. We have $592 million of funded debt under our revolver. Billed receivables increased approximately $20 million sequentially due to the timing of invoicing collections in the quarter, and $10.5 million reduction to our receivables factoring in the period. Unbilled receivables decreased sequentially approximately $21 million, due in part to continued successful execution and billings across the program portfolio. Inventory decreased sequentially $8 million, primarily as a result of the increased throughput across a number of programs. Notably, while inventory decreased approximately $2 million year over year, WIP is up approximately 44% from our prior fiscal year end, reflecting an increased mix of inventory that has progressed toward delivery. Prepaid expenses and other current assets decreased sequentially approximately $26 million, primarily from the income tax refunds during the quarter of $24 million. Accrued expenses increased during the fourth quarter, primarily due to $20 million of accrued compensation costs related to our incentive compensation plans and payroll expense. Deferred revenues increased approximately $3 million in the quarter as a result of additional milestone billing events achieved during the fourth quarter. Working capital decreased approximately $62 million, or 10% in the fourth quarter, and approximately $93 million, or 15% year over year. These decreases evidence the progress we've made in reversing the multi-year trend of growth in working capital with sequential reductions in inventory and unbilled receivables. Turning to cash flow on slide 14. Free cash flow for the fourth quarter was $61.4 million as compared to $3.8 million in the prior year. As Bill noted, this marks the highest quarterly free cash flow in the company's history. As Bill had outlined in his earlier comments, we will not be providing detailed guidance for FY25 at this time, but I would point you to slide 10 for some qualitative comments. In closing, we believe continuing to execute on our 4 priority focus areas will not only enable a return to historical revenue growth and profitability, but will also drive further margin expansion and cash conversion, demonstrating the long-term value creation potential of our business. With that, I'll now turn the call back over to Bill.
Thanks, Dave. With that, operator, please proceed with the Q&A.
Thank you. We will now begin the Q&A session. If you would like to ask a question, please press star 1 on your telephone keypad to raise your hand and join the queue. And if you'd like to withdraw that question, again, press star 1. We also ask that you limit yourself to 1 question, and for any additional questions, please re-queue. Your first question comes from the line of Pete Skibinski with Alembic Global. Please go ahead.
Hey, good evening, guys. Nice quarter.
Hey, Pete.
Maybe we could start out talking about the CPA area and the 4 challenge programs there. You seem pretty confident that it's going to shift to full rate production. I don't know if we should think the end of the first quarter or the end of the second quarter, but maybe you could go into more detail about the reliability testing and why you're confident that will complete. And when it does complete, are those 4 programs not going to generate a meaningful amount of revenue this year? Is that the right way to think about it? Thanks.
Yeah, thanks, Pete. So just to reiterate where we are, we've gone through root cause corrective action, put in place the manufacturing process changes based on our understanding of the root cause and the material science, have been very deliberate in ramping up the production line with a lot of in-process testing along the way and really pressure testing the corrective actions that we put in place. All of that has been going to plan. So I feel really good about the progress to date and how things are progressing. We have plans to ramp up to full rate production in the first half of the year. And as I mentioned, the critical path to ramping up is really behind us. We have the capital equipment in place. We have the additional people trained that we need in order to ramp up to full rate production. So I feel pretty confident about the path we're on to ramping up. And so we have a backlog that we need to deliver on. I think there is a combination of programs where the majority of the revenue has been recognized and backlog where we will recognize revenue. And we'll work out how we allocate the production across the capacity as we ramp that up. And so that will play out over time as we work our way through the first half. But I'm anticipating that as we work our way through the first half, we will get up to full rate production. We'll work through the unbilled and the backlog associated with those programs. We're holding the 4 programs open really through the ramp of production. But as I said, everything seems to be going to plan. And then as we said before, as we ramp this production up and we make progress on delivering to our customers, there are follow-on opportunities that we're expecting to see. So I'm pretty optimistic about where we are right now. Feel very pleased with the progress that the team has made and look forward to working our way through the first half, which I think will give us much better visibility into the second half based on the progress that we actually make. Hopefully that's helpful.
Your next question comes from the line of Jonathan Ho with William Blair. Please go ahead.
Hi, good afternoon, and let me echo my congratulations on the strong quarter. Just wanted to understand, when we look at your, I guess there isn't formal guidance, but when we look at 2025, what are the levers that could swing your results either more positively or negatively, as we look towards the future? And it does seem like you have stronger visibility. So, what is sort of, maybe keeping you from giving that guidance? Thank you.
Yeah. So first, let me just speak to the visibility. A year ago, we were talking about the path toward our targeted profile, and in particular, our margin profile. And we had a number of factors that would bridge us from current level of performance to that targeted margin profile. And it was things like, first, reducing the volatility that we had seen in the business tied to EACs, inventory write-downs, contract matters, RMA reserves, et cetera. Second, making progress on our cost structure. We've built this business through 15 acquisitions over 9 years, and so, really needing to integrate the business and drive efficiency into our cost structure. We talked about a mix shift toward production and the margin uplift that would come with that. And then the rest of the bridge toward our target margins was really around other efficiencies and operating leverage that we would see, primarily driven by the volume increases associated with development programs transitioning to production over the next couple of years. So you fast forward to today and your comment on visibility. Our backlog's at a record high, and that provides a certain level of visibility. We've also made great progress over the last 12 months in a couple of those areas in the bridge. First, in reducing the volatility, and you can clearly see the trends as we've worked our way through the year, and then how we were able to work our way and manage that volatility in Q4. We made very significant progress on our cost structure and driving efficiency through the cost structure. And you saw the progression through the year and the run rate savings that we talked through. So now as we think about going forward, the things that I'm keeping an eye on that will really dictate the speed to which we move towards our target profile. That's above industry growth rates. It's EBITDA margins in the low to mid 20s, and it's free cash flow conversion at 50%. So the speed with which we'll move toward that targeted profile will be dictated by some things that happen in 25 and some things that happen outside of 25. In 25, in the first half, we're focused on development program execution because that really drives how quickly production programs will ramp up. In particular, the ramp up of our common processing architecture, because as I just mentioned, there's unbilled and cash, there's revenue tied to backlog, and then there are follow-on production awards that will come with that. And then we have other follow-on production bookings tied to development programs that we've been executing on, we've recently completed, and we plan to complete. And then we also have our operational capacity, which, as we said in our prepared remarks, in the near term, we're allocating to programs with high unbilled balances, which will free up a lot of cash, but there won't be much revenue associated with that. So that's what our, qualitative commentary is all based on. So to your question of, what would lead things to impact our financials faster, I think it would be our completion of development programs, the success in the ramp up of our common processing architecture production line, how fast our development programs are transitioning to production and when we see those production bookings, and how quickly we're able to burn down the unbilled balances so we can free up the operational capacity and put it back toward backlog with revenue. So those are the factors. Those are the things that we're focused on. And my expectation is as we work our way through the first half of the year, we'll get really good insight, obviously, into our progress in each of those areas, but then the implications on our outlook for the second half of the year and the full year. So those are the things that we're thinking about and what I think we can point to as to what will drive the second half and whether things, happen quicker or not. So I know, Jonathan, a long answer to your question, but hopefully that rounds out the picture.
Your next question comes from the line of Ken Herbert with RBC Capital Markets. Please go ahead.
Yeah, hey, good afternoon. Thanks for taking the question. I just wanted to ask, as you look at the sort of the push towards, continued risk reduction and getting obviously to the 20/80 split, you talked about in terms of development to production programs, when do you expect to sort of cross that threshold? And then as part of that, there seems to be, significant sort of new business opportunities today, just when you look at the growth in sort of spending and outlays today and a lot of what's happening in defense markets around missile defense and other areas. What is your appetite for sort of new business these days? And are you able to participate in some of the opportunities today as you continue to drive down the risk profile?
Yeah, Ken, great question. Thanks for the question. Well, look, I think we feel very good about the market, the tailwinds, our positioning, And I think that's evidenced by what we're seeing in our bookings at 1.22 for the year, our book-to-bill, and our record backlog. What we've been really focused on, based on what we've seen in the business over the last several quarters, is managing the volatility in the business and specifically what we bring into the backlog. So this last year in FY24, we brought in a number of development programs, but many of them were cost plus in nature, which we think is much more aligned toward us working on next generation products, introducing innovation, getting new platform positions, but having a set of contract terms that are more commensurate with the risk than what we've seen looking backwards, where we felt like we had a high concentration of firm fixed price development programs. So we feel like we're striking the right balance of pursuing new opportunities, taking advantage of the opportunities in the market and our positioning, but doing it in a much more appropriately risk-adjusted manner with the cost-plus nature of the contracts. Pulling those aside, getting to your mix question, when we look at our firm fixed price bookings over the last year, we've seen about 80% of our firm fixed price bookings as production bookings versus development. So I think that's a leading indicator of the mix shift moving in the right direction. And then in addition to that, over the next 12 months, since such a high percentage of our backlog converts to revenue over a 12-month period, the margin dynamic that I referred to, where our margin today in our backlog is slightly lower than what we would expect to see going forward, driven by a small number of legacy development programs that were either impacted by EACs or have very low margin, or where we're investing because we think the return warrants the investment. I think that should all transition over the next year and be replaced by higher margin bookings. And we already started to see that in FY24. And so have a good feel that we'll be transitioning that backlog margin out over the next 12 months and see the improvements that we expect to see. So anyways, I think that transitioning to the mix should continue to happen over the next 12 months. And we don't think that we're passing on any market opportunities because of some new approach to risk. We think we're pursuing those opportunities, but with the right contract terms around them.
Your next question comes from the line of Michael Ciarmoli with Truist Securities. Please go ahead. Michael, please press star one again.
Sorry, can you guys hear me?
Oh, yeah, now we can hear you.
Michael.
How's it going, Michael?
Sorry about that. Good. Sorry about that, guys. Just first a clarification. Are the CPA-related programs, are they going to be margin dilutive relative to normal historical fixed price programs once they do, or relative to production programs when they ramp up?
I don't think so at all. I mean, first of all, there's nothing around the root cause corrective action that would even incrementally affect our gross margin on those programs. And I think this is an area where there's strong demand, there's tailwinds in the market, we have differentiation and really a unique capability to meet very stringent mission requirements that, if anything, I could see the opposite effect and actually being additive. So no concerns about them being dilutive to our margins.
Your next question comes from the line of Sheila Kahyaoglu with Jefferies. Please go ahead.
Thank you, guys. Maybe just on that last point with EBITDA margins, they were better in Q4, but then stepped down just given the backlog dynamics you both talked about. So is that just timing, and we should expect low double digits to be sort of the normalized level in 25 and stepping up in 26?
Well, I think there's two impacts, and I'll start, and then Dave can chime in. But I think the two impacts are both the backlog margin dynamic that I pointed to, and then just volume. And so, we're expecting to start off the first half of the year in high single digits, But as we move to the back half of the year and we see the margin transition in the backlog, and we also see the additional volume in the second half, we expect to see an improvement in our margins tied to those effects, so the transition of the backlog and the positive operating leverage. But Dave, please add if there's...
Yeah, no, I think that's right, Sheila. I mean, it is, largely driven by the margin in the backlog. And so we expect that to increase as we go through the year, and we're replacing, new bookings for things that we're burning out of backlog. And as we complete some of the contracts that we have some tailwinds on, from the prior EACs, but then it is the other side of it is exactly what Bill said. We've been a business that largely in the first half of the year has lower volume and then ramps up in the second half of the year. And you saw that again in the fourth quarter. And so that volume will definitely drive improved operating leverage and higher EBITDA in the back half of the year.
Your next question comes from the line of Jan Franz Engbrecht with Baird. Please go ahead.
Good evening, Bill and Dave. Congrats on the set of results. I'm on for Peter today. My first question, a big focus in fiscal year 24, we're focusing on retiring the technical risk outside of the common processing architecture, and you're very much on track with your prior messaging, having solved at least 13 of these. But is there anything that you're tracking internally in terms of unbilled receivables or any metric or ratio that you want to achieve in fiscal year 2025 that we can sort of track over the next few quarters as you report?
Well, I think the KPIs are really consistent with driving toward the target profile that we've been very consistent in describing, and that's above industry growth rates for the top line, EBITDA margins in the low to mid 20s, and free cash flow conversion of 50%. And addressing, the two primary transient challenges that we've seen in the business, which is a high mix of development programs and high working capital. FY24, we made significant progress on the development programs and mitigating technical risk. We also made considerable progress on the working capital, and that's a KPI that we continue to be focused on and expect to see that continue to come down in FY25. And also in FY25, see a step up in those KPIs associated with our targeted profile. So step up in our top line growth rate, step up in our margins, and again, being free cash flow positive for the year. So I think it's just a continuation of the KPIs that you've heard us talk about for the last year, and certainly our focus for the last year, and the 4 priorities that we put in place just over a year ago.
Your next question comes from the line of Pete Skibinski with Olympic Global. Please go ahead.
Yeah, thanks, guys. Just want to understand something, because LTAMs, it's a big program opportunity for you, I know. And I just want to understand more on that front. Is it one of the 4 CPA programs? And I ask because I think Raytheon got a very large, I think it's sort of an LRIP order. And so I would expect you guys to receive an order from them at some point, I guess, relatively soon. And so was just wondering if you could give some color on that for us. If it's one of the remaining issue programs, and whether or not it is, should we expect a large booking later this year related to that?
Yeah. Thanks, Pete. And I'm sure you've seen the recent announcement from Raytheon about their funding, and I won't comment on that, but which we think is good news. To answer your question directly, it is not one of our challenge programs, and it is separate from the 6 that I addressed, the 2 that I think are just ordinary course risk, and then the 4 that are tied to the CPA. And it is a program where it represents us successfully completing a development program, and then in FY24 getting a production award. I also think it reflects our disciplined approach to execution and how we're approaching that program, meaning strong program management, system engineering upfront, being very disciplined in how we order material and stage it, consistent with our integrated master schedule and are executing on that program in a very deliberate manner right now. So it's one of the programs we feel very good about. We talked about in the past that we do expect that to be a driver of organic growth going forward, and our expectations remain the same on that front.
Your next question comes from the line of Michael Ciarmoli with Truist Securities. Please go ahead.
Hey, guys. Thanks for taking the follow-up. I guess, Bill, you touted the book-to-bill, being strong. Bookings are down 2 years in a row. I mean, are you guys losing share? And can you talk to that and talk to whether or not the core underlying business is actually showing growth?
I'd say the one dynamic that we've seen relative to bookings in FY24 is that some of the challenges that we've had on development programs have led to delays in bookings. I wouldn't characterize them as lost bookings. And I think a great example of that are follow-on orders associated with our common processing architecture, where we deliberately, stood down the line so that we can put in place the corrective actions. We're ramping it up, and we expect to see follow-on orders coming as we make deliveries to our customers. And when I think about our pipeline, our conversion rates, I don't see anything in our conversion that gives me concerns around competitive dynamics and losing market share. So we feel good about our book-to-bill given where we are. I think that's a good leading indicator of where we're headed. And if anything, we've just seen some delays rather than losses tied to the development programs.
Your next question comes from the line of Noah Poponak with Goldman Sachs. Please go ahead.
Hey, everyone.
Hey, Noah.
Thanks for the time. I think you referenced a few years of transition from development to production in the main programs that you're alluding to in that mixed transition. Does your fiscal 26 look like the medium-term profile that you're referencing, or should we be thinking of, more than just fiscal 25 as kind of transition years to that run rate profile? And when do you next expect the business to have positive GAAP net income on a full year basis?
I'll let Dave take the last one. Let's see. On the transition, as I think about, again, the bridge from where we are toward our target profile, really with the progress that we made in FY24, there are two pieces of the bridge that I'm most focused on. One is the transition out of backlog of the remaining low margin development programs and the programs that have been impacted by the FY24 EACs. That's going to give us a step up towards our targeted EBITDA margins. The rest of the step primarily is going to come from the volume lift that we'll see from development programs that we have in-house, that we've executed on, where we're awaiting the transition or working through the transition to production. Now, there's a number of those programs. It's not one or two, it's a number of them, and they each have their own profile. But as to roll forward into revenue, but as I think about our organic growth over the next couple of years, it's going to be primarily driven by those development programs and their transition to production, and they happen on different timelines. We talked about LTAMs as more near term, but we have a number of other programs that will be feathering in as we exit 25, as we work our way through 26, and get full run rate benefit of those programs in the back half of 26 and 27. So there's a number of different programs, but as I think about our organic growth for the next couple of years, I think we have good line of sight tied to the development programs that we've won, executed on, and are working our way through the transition from development to production.
Yeah, and I think I would point back to, Bill's comments and around the color we're putting around FY25, and that's that we, I point back to our adjusted EBITDA margins that we expect, which is low double-digit adjusted margins overall in fiscal 25.
Mr. Ballhaus, it appears there are no further questions. Therefore, I would like to turn the call back over to you for any closing remarks.
Okay, thanks. Thank you, operator, and thanks everyone for your interest and participation today. And we look forward to providing another update on Q1 FY25 in our next earnings call. Thanks very much.
Thank you.
This concludes today's conference call. Thank you for your participation, and you may now
Whoops-a-daisy, I was muted there. Just bear with me a second. I forgot to unmute myself. Okay, thank you very much for joining me. We've got a premiere about to start right now. It's 3 minutes, so let me just send you all to this big event tonight. It's NVIDIA warning for the morning, CPI. So here we go. Let me give it to you now. There it is in the chat. Okay, you've all got that? Whoops-a-daisy, I was muted. And let me now send you... to that one. Here we go. So it'll automatically go there. What a night this is. And we've got 2 earnings in the morning, 2 hours, 2 after work as well. We're going flat out now. We're just gaining speed all the time. It's so exciting. So anyway, here we go. Let me send you now to NVIDIA CPI warning. It is 2 minutes before it goes live. Here we go. Let me just double check I got that right. I always double check myself. There we go. CPI warning. That's it. Thank you very much indeed. Love you all. What a great night. We're going faster and faster and faster now. Only a couple of days ago, we were at 30,000. And literally, what's it, 3 days ago? We're 30,718. Done nearly 1,000 subscribers in 3 days. It's absolutely unbelievable. What a journey this has been. Anyway, I'm going to end the show right now. Thank you so much indeed. See you on the premiere right now. And then back in the morning, I've got 2 more earnings in the morning and then 2 tomorrow night. It's getting mental here. See you back in a bit. Bye-bye for now.